In this video, traders, we are going to look at the three-step approach to risk. Stick around. Hey guys, warm welcome to you. All right, so three-step approach to risk. Now we know the traditional approach to risk is, hey, how much do you want to risk per trade? You've got an X to 1 risk reward ratio, 3 to 1, 2 to 1, whatever it may be, and you kind of work from that. But I think that misses the bigger picture. That's fine. And if you're a beginner trader, that's exactly really what you should work on. Your risk per trade, your risk reward ratio, look at finding trades that are going to give you a good multiple of R return. That's a great place to focus your energy. However, if you're more intermediate or more advanced, then I think you have to blend your risk control in with the real world of trading, in with your personality, in with the market conditions and all these other things. So the first thing is, which I really cannot recommend highly enough, guys, is to set a safety net. So what do I mean by setting a safety net? Too many times as traders, we cruise around, we've got a certain amount of money in our account, and we don't think we're going to risk all of that money, but actually we can get into a situation where we draw down way more than we expected just because that money's in the account. Let me give you an example. You've got $100,000 in your account. You think, you know what, I'm not going to risk more than, maybe you're risking 200 bucks a trade. Maybe you're trading very conservative. You're kind of, you're getting the right type of trades. But with that $100,000, if you went on tilt, if you had something catastrophic happen to you mentally or in the markets, then that capital is all at risk. So one thing that I like to do is, hey, work out how much you need to trade with, work out how much you're prepared to risk in a week, and have just enough to keep you going for a week or a month. You might not need the full $100,000 in your account as buying power, as margin, all this stuff. You might need $20,000. Now this might seem, okay, what's the chance of me losing $100,000? Fine, but it's one part of the safety net. You know, you get into a situation where, let's say you go on tilt, you're adding to positions, you're doing all sorts of stuff that you know is not conducive to long-term success, and you lose a significant amount of money. At least you're not going to lose more than the margin requirement needed for the positions you've got, because you're going to open the position. So whatever that might be, maybe you're going to lose 13,000 max. If you had 100,000, then you just went crazy and you kind of got caught out in stuff, then you could lose all of that money. You could lose, right the way down to, whatever that number brings it to. You could lose $80,000 or whatever it is. So the point is that, and if you're trading CFDs and spread bet, trade accordingly. You don't need all the money in your trading account. Don't put it in your trading account. It's not necessary. Have as much as you need to do business. Portfolio of positions, you're gonna have to have more trading, more equity in there for your margin, etc., etc. But you don't need to store everything in there because you just don't know what's going to happen. And so that's the first part of the safety net. The second part of the safety net, that's kind of operational side of things. Second part is just understanding, hey, how much am I prepared to draw down this week, this month? And having that as you don't have to kind of overdo it and think negatively all the time, but saying, hey, I'm not going to let this account balance fall down under $90,000 this month, this week, whatever it may be. Whatever your account balance is, doesn't even matter. But just saying that and having that as a kind of non-negotiable rule is a safety net, because you don't want your equity curve up and up and up and up and thinking things are going to go great and then dipping down and going, oh, I'd like to just get back to highs, and then going further and further, and before you know it, you've undone kind of 25%, 50% of the work. So have that as a safety net as well, of how much I'm prepared to draw down off the peak of highs before I step back and kind of review what's happening. So safety net, the money in your account and thinking about drawing down. So that's a kind of global picture. That's looking at your amount of money you've got on account, the amount of money you've got to risk in trading. So let's go down from a trade perspective. Number two is reverse engineer the risk per trade. So I talked about this before in a lot more depth, and I'll touch on it now. And go and check out the video, guys, where I kind of drilled into this a lot more detail. But I think there's a little bit of a fallacy of I'm going to risk X percent per trade or X pound per trade. And that's fine as a base rule, but ultimately you've got to think how many trades you're taking a day, a week, a month, a quarter. If you're a very active day trader, you're doing 10 trades a day, you're risking 200 bucks a day, put 200 bucks a trade, should I say, that's $2,000 a day, 10 trades, 200 bucks. That adds up. You know, over the month period, depending on how many days you're trading, that's a significant amount of risk. Now, of course, you have to lose every trade if you have the maximum risk, but that's far different from a swing trader who says, hey, I'm risking $200 a trade and I trade 5 times a month. You know, that may be the same risk per trade, but the risk parameters are massively different. You know, a day trader who's trading on that and has a bad quarter can decimate an account. A swing trader has a bad quarter, it's going to be a drawdown, it's going to be decimated. So reverse engineer your style, the amount of trades you're taking, and work out the risk per trade from that, because that will give you a bit more of an indication of really what's my risk, what's my kind of broader risk that I'm taking in the market, rather than each individual trade and taking many of those and realizing you're down $2.5 grand. In reality, there's no way you wanted to risk $2.5 grand in a day or in the month or whatever it may be. So consider that. The third and final thing, guys, is know where your weaknesses lie. Now, this is, okay, we're probably stepping away from kind of strict risk assessments and an approach to risk here, but I think it's super important to mention this. You know, recognize where your vulnerabilities lie in trading. Do you have a tendency to overtrade? Do you have a tendency to be a FOMO trader? Are you diving into stuff, revenge trading? Do you have a tendency to maybe hold things overnight that you shouldn't do? Do you have a tendency to kind of buy shares, for example, that are kind of very aggressive at the open, and they kind of, there's something that you know is a weakness for you and causes damage to your account that you could probably limit. And so this is when we kind of step back from things and go, hey, do you know what? I get caught out quite a lot doing that. I get caught out quite a lot buying early day breakouts. I get caught out quite a lot trying to trade volatile biotechs, for example. I get caught out trying to trade dollar on Fed day. Something which adds more risk than you realize, because there's one thing to say I'm going to risk X amount of dollars per trade or X amount per week or whatever it is. There's another thing to be able to stay outside of those conditions or inside of those conditions, really, and saying, hey, I'm not risking this. And under normal conditions, you're probably okay. You're probably just risking this, you're probably just risking that, you're fine. You stop when you say you're going to stop, you draw down, you stop, you pull back. But there are certain conditions where your weaknesses lie, where you get so caught up in it, before you know it, you've risked more than you wanted to risk, you draw down more than you wanted to, and the kind of chimp gets activated and starts going, oh, I've broken all my rules and this and that. And this is a risk assessment. This is not necessarily, from trading perspective. This is like, okay, how do I limit my risk? Well, don't get myself into positions and situations where I might go crazy and go on tilt and start trading wildly and start trading too much size and start trading too many instruments. So being very objective and assessing that and saying, hey, I can be vulnerable in that. After a series of losers, I can go crazy and start adding to positions in these conditions, etc. So recognizing that is a key approach to risk. So yes, we've got additional ones out there. Yes, we kind of touched on those slightly, but the safety net is a good way to approach things. Hey, that's the worst case scenario. Money in the account, how much I'm going to draw down, fine. Third one, we'll skip from 1 to 3 here. Know where your weaknesses lie. So knowing where your vulnerabilities, where can you get into a situation potentially where you can do damage to your account? And be honest with yourself about that and say, okay, watch out for that, avoid that. Or if I'm in that situation, be very mindful that I'm not going to do significant damage to your account. And then number 2, reverse engineer your risk per trade, working out how much you're trading, how frequent you're trading, and then working it back from that, saying, where am I okay to be? What's my maximum drawdown allowed in my equity curve? Oh, it's X. Well, that means that actually I have to risk a little bit less per trade because I'm quite active in the markets, or vice versa. Anyway, guys, that is my 3-step approach to risk, something a little bit different from normal. Take care. See you in the next one. Bye-bye.